In addition to the historical series of economic and financial data, great attention must be paid to the trend of current trading, i.e., the performance of the company in the months in which the sale procedure will take place, both of the M&A or IPO, and its alignment with the budget of the current year. It is important to grasp whether the target firm is able to manage throughout the exit process by itself. Realization of an exit strategy may involve a relevant amount of time and money to pay for advisors, especially during an IPO process. Before conducting an exit strategy, a company will be subject to a stringent due diligence process to ensure that all of the proper systems and controls are in place. A company is in a position of strength if its track record shows it consistently outperforms performance targets. A fundamental element to consider while choosing the right moment to implement the divestment is the condition of the markets, both for M&A and stock exchanges, and last but not least, for acquisition financing. In difficult market situations, i.e., a crisis or a so-called black swan, the mortality of deals increases exponentially, and there is a rapid downward pressure on prices, resulting in a gap between buyer and seller. Also, the IPO market is heavily affected by the shocks, with a mortality that occurs very quickly and with a flow of new stakes that is interrupted and that can remain at zero for months. The investor who is preparing his exit path must foresee the conditions of the markets with a few months in advance, and not base the choice of the exit timing only on the growth of company performance. In the presence of a crisis on the markets, the reaction of the buyers is very rapid and can even endanger the deals between the signing and closing phases, if there are stringent clauses of material adverse change or, subject to financing, in the contract. In addition, deals for which a sales contract has not yet been signed may suffer a decrease in transfer prices, extended due diligence times and a high risk of abortion of the deal as a whole. In the selling procedure, starting from the choice of the right moment, the active collaboration of all partners, in particular, those operating in the company, is necessary. Asymmetrical and uncoordinated behavior and interference in the sale procedure can create disruption and jeopardize the entire process. The need for alignment and responsible attitude must naturally also be extended to advisors, in particular to the investment bank responsible for the process, called upon to provide a reliable estimate of the future sale value and to suggest the most appropriate time window, avoiding any conflict of interest.